All right. So thank you for having me. I had a paper many years ago on the program once, but I couldn't come at that time. So I'm really, really happy to have a second chance to come to this wonderful conference. So the paper is Platform Money. It's joint work with Yuan and Kathy from both from LSE. They share the same name, but I'm pretty sure they're different Chinese characters. So, okay. So what's this paper about? So, we see, in the last several years that platforms, there's a rise of platforms that match buyers and sellers to create trade surplus. Okay. So there are many examples: Amazon, Uber, and in China, the big platforms like WeChat and Alibaba are all matching platforms. Now, these platforms aspire to, and some of them actually do it very successfully, to have also their own digital payment systems, their digital tokens. So, I put here DM Libra, which is a failed experiment, but it had a lot of potential. Didn't work for various reasons, but WeChat Wallet is like a super successful example. And then, for example, Uber has its own Uber Cash. Many of you probably don't use it, but if you wanted to, it's there, and maybe some of you do use it. Even airline miles are examples of these kinds of tokens. And in fact, in some platforms, you cannot even conduct any commercial activity without having the platform tokens. For example, WeChat would be an example. So what we want to do in this paper is we want to understand how does the ability of a platform to issue its own tokens or money influence the competition between a platform and what we're going to call a legacy market, okay? These two different marketplaces. And so the basic setup is that, as I said, there are two marketplaces. One I'm going to call platform, the other one I'm going to call legacy. And the legacy is going to use outside money, okay? So we're not very specific about what this outside money is, but you can think of it as fiat money, could be your credit card or something like that, okay? Outside money inflation is set exogenously in the model. You can think of it as like a central bank setting it. And we're going to borrow from the money literature. Basically, the model will be a Lagos Wright type model, where when a buyer and seller meet, they the buyer has to make a payment using money on the spot. And on the platform, in the benchmark model, on the platform, trades are going to be executed using platform money, and on legacy, they're going to be executed using outside money. And in each period, this is an important friction in the model. Buyers and sellers they have to choose which market to participate. Okay. Now, the questions that we want to ask are, how does how does money affect the two-sided market dynamics? The matching rates, gains from trade, things like that, and how does the platform choose its money growth given the outside inflation? What are implications for search and matching? And in later part, I'll also talk a little bit about, why do some platforms entirely ban outside money while others accept it? Okay. So that will require a slight generalization of the model. Okay, so let me jump into the model. So there are two. Basically, it's an infinite horizon setting, and I feel like I skipped a slide. Okay, here it is. So so the time is discrete. There's a discount factor beta, and each period is split into a decentralized market, which is a goods market, where the trades happen, and then there is a money market where people adjust their money portfolios. Okay, actually, a bunch of things happen in the money market. I'll explain in a second. So this is the Lagos and Wright kind of framework. And there are N bar B buyers, N bar S sellers, and there are the platform owner and legacy owner. These are the players in the game or in the model. And there are two types of goods. One is a consumption good that's traded in the DM. Okay, buyers need 1 unit of it, if they get 1 unit, they get utility U. And sellers can produce up to 1 unit at 0 cost. And exchange is facilitated with money. There is another kind of good, which is a numeraire good. If you like, you can think of this as labor, which is just a trick to basically make the model kind of history independent and also denominate everything in terms of this numeraire in the model. Okay. So in the DM, there are search frictions. So when buyers and sellers decide to go, let's say, to the platform, depending on the number of buyers and sellers, there is in the background a matching technology which creates a bunch of matches. Okay? So we're going to assume that this matching technology is constant returns to scale. And the reason is, I think it's a good benchmark. So there could be congestion, if too many people go to the same market. There could also be, increasing returns to scale from having more people. So, those could be, we can think of those separately, but I think as a benchmark, we're going to think that, if double the number of buyers and double the number of sellers go to the same market, there will be double the number of matches between them, okay? So this basically means that the only thing that matters in terms of matching is the seller-buyer ratio, sometimes called market tightness. Okay, so, the buyer's match probability increases in this number. If there are more, if the seller-buyer ratio is higher, buyers are more likely to be matched and sellers are less likely to be matched. Okay. Now, in the CM, there are no frictions. Here, marketplace owners set entry fees for buyers and sellers, which are paid to the platform and the legacy in the numeraire good. Okay. And platform also decides its money growth rate, its inflation. Okay? And buyers and sellers observe these fees. They also observe the inflation, outside inflation and the platform inflation, and they decide where to go. And then they're going to hold kind of enough money to enable trade if they go, whichever market they go. Okay? That's, and then there will be a money price that comes from the market clearing in this market. Now, so this is kind of the timeline. In the DM, sellers and buyers search and match. If they meet, they transact using the money that they brought in. And in the CM, platform issues new money. Platform and legacy post their fees. And agents pay the relevant fee, whichever place they're going. Remember, they can only go to one, and they adjust their portfolios. Okay. Now, so I'm going to denote supply of money in market J as MTJ. So inflation is the money growth. Equivalently, it's also the price. Phi is the price of money in terms of numeraire good. Because they're issuing money, this price is falling, right? So it's basically this price ratio of money is also inflation. You can write it in either way. And we're going to assume actually that buyers and sellers don't hold money just for for non-trade purposes. They only carry money. Carrying money is costly, so they will only carry money of the type that they need, whichever market they're going. Okay. So this is probably the busiest and heaviest slide. So let me try and explain this. So buyers, so we're going to have a discrete choice setup. So buyers are going to, in the CM, they're going to look at what is my payoff from going to platform, what's my payoff from going to legacy, and they're going to choose whichever one is better. Okay? Now, when they do that, they're not just simply going to go to the one that's better. There's an idiosyncratic taste shock, okay, which basically avoids the model being, completely Bertrand. Okay, so it makes the model smooth. So they're going to basically look at how much value they get from each, and then they're going to also have this taste shock, and they're going to go taking into the taste shock into account. They're going to go to the market that they prefer. Okay. Now, what is the payoff? Well, they have to, if they go, they potentially have to pay the fee. So this is for the buyers. If they are matched, they get utility. Remember, so okay, what's this gamma? Again, I feel like I skipped a slide. Let me see. Yes, I did, of course. So I don't know, something with the clicker, and it just jumps sometimes in one slide, so I have to back up a little. So, so consumption good in the DM is consumption good price is derived using Kalai proportional bargaining. So this Kalai, it's not a misspelling, so it's a different Kalai. So this is Ehud. It's your cousin, I know, he told me. So actually Ehud was my advisor in grad school, so I'm really glad that I found the opportunity to cite him in a paper. But anyway, so we're gonna use his bargaining solution. And effectively what this says is that if buyer's bargaining power is gamma, he needs to give the seller 1 minus gamma u, okay? And therefore, he has to carry, in real terms, enough money to exactly pay that, okay? So the price is going to be the price in the real price here. So this is how much money you're giving. This is the price of money. So this is in terms of numeraire. You have to carry exactly this much money with you. Okay. Now, coming back here, okay, so you have to pay the fee. And then if you're matched, you get gamma u. This is like the buyer's gain from trade. And then there is cost of carrying money. This is how much money you're carrying. It's discounted. There's the discounting, but there's also inflation. Okay, that also makes money less valuable, so you have to pay the cost of carrying money. Now, we're going to throw in a parameter here. It's really, I'll tell you exactly what it does. We could do without it, but I think it makes the model more interesting. So this is a salience parameter, which says how much do people really pay attention to inflation? Okay, so it could be equal to 1. Actually, I should have put less than or equal to 1 here, because we could allow it to be 1. So that's a typo. But if it's less than 1, you don't pay full attention to inflation cost, okay? Just think about like all the money that you're holding in your checking accounts or in your like airline miles that you have, which keeps like losing value, and maybe you're not like totally, I mean, I am not, okay? So maybe you guys are better than me, you're finance professors, but you know, I actually lose a ton of money because I don't pay attention to inflation as much as I should, okay? But, okay, so now this is, whichever market you're going, this is the kind of the value that you're getting. When you're comparing, we're going to look at the difference between the two, okay? So there's going to be difference that comes from the utility gains. There's going to be a difference that's from the inflation costs and the fees, okay? And then you choose, so the fraction of people that choose the platform will be the fraction where this difference exceeds the shock difference, okay? And in fact, in the paper, most of the results are for this to be a Gumbel distribution, so this is gonna be a logistic function, okay? So that's in the background. Okay, and there's a similar thing for the sellers, which gives the attraction function for the sellers. And then legacy and the platform are gonna choose their fees and inflation optimally, okay? And here, basically, legacy is going to get this many sellers, okay? And it's going to charge this fee. And it's going to get this many buyers, and it's going to charge that fee. And then we're just going to take the first order conditions here for this. And for the platform, it's a little bit more involved. Platform gets revenue from sellers. It gets revenue from buyers by charging fee. And it also gets seigniorage revenue, okay? Which the legacy didn't get because seigniorage there is going to the central bank or whoever is issuing the money. They don't control the money, okay? So this is the main advantage of having your money, is that you can pocket the seigniorage. And then and what is the seigniorage? Seigniorage is basically the number of buyers times, so this is the market clearing condition basically. So number of buyers times the money that they carry times the increase in money supply should be equal to the seigniorage. And if we plug this in here, you find that basically inflation and fees are perfect substitutes. Okay, you could choose one or the other, except this parameter in the attraction function makes charging through inflation better, because when you charge through inflation, people feel it less. Okay? Now, this is the only place where this is important. If this was 1, actually there would be no problem, except that we would say you just can choose inflation and fee in any way you want as long as it's optimal, the combination is optimal. Once you have this to be even slightly less than 1, you just want to charge it through inflation, okay? And so that's the result down there. Now, I want to make this very clear. The platform strictly prefers using its own money, and it's not because of the psi parameter, okay? So as long as there is a strictly positive inflation in the outside world, platform will want to use its own money. And the reason is, if you accept outside money, you're losing, you're losing the seigniorage. You cannot charge as high a fee anymore. So you're basically, this gain is leaking. So you would rather, even if you were setting your inflation exactly at the outside inflation rate, you would rather do it with your own money, okay? So that's the main advantage. Of course, if you, on top of it, if you have this parameter strictly less than 1, that gives you a second reason to use, to prefer your own money. So the only time platform would be indifferent would be if both of these are equal to 1. Now, let me say that this salience also, it's not like you always the platform prefers salience. In fact, salience is a double-edged sword, okay? If outside inflation is high, in fact, the platform would do better if the buyers are more attentive to inflation, okay? So it really depends whether salience is a good thing or a bad thing, depends on whether outside inflation is high or low, okay? If it's low, of course, you're going to set, in fact, I'm going to show you a result where you want to set inflation higher than outside, then you would like them to be less attentive. But if outside inflation is high, you actually set an inflation rate that's lower than outside, and then you would prefer that they pay more attention to that, okay? So, okay. Now, some results. So the first result is that there are more buyers on the platform because of the platform's ability to issue money, because they basically have a cost advantage relative to the legacy. So they can attract more buyers. But then once they attract more buyers, there are cross-network externalities. More buyers means seller-buy ratio is lower. So sellers are more likely to find buyers on the platform. So more sellers are going to join the platform, which means more buyers are going to join the platform, and so on. So the second result here is that sellers actually are more likely to be matched on the platform, okay, and relative to the legacy. So now when they have the same matching technology, this means actually that that seller-buy ratio is lower on the platform. Basically, the platform has relatively more buyers. Okay? And that's something you would expect because they have this money, so they can attract buyers more cheaply. But it turns out if platform actually has superior matching technology, you can even have a situation where there are actually the seller-to-buy ratio is higher on the platform. So the platform actually ends up, because of these cross-externalities, ends up actually attracting more sellers. And despite that, because it has the better technology, it's more likely to match these sellers with buyers, okay? So that's possible, okay? In fact, in equilibrium, platform always charges a higher fee to the sellers, and despite the higher fee, attracts more sellers than the legacy market because of better matching. Actually, maybe I shouldn't have this here because even when the matching technology is the same, this is true. Okay. So now about the result that I was talking about before. Now, it turns out there is a threshold outside inflation. If the outside inflation is below that, actually, platform charges a higher inflation than outside, and if the outside inflation is above, it will charge a lower inflation than outside. Okay, and the reason for this one is even if platform inflation is 0 or equal to 1, even if outside inflation is equal to 1, platform would like to have some inflation, okay? So initially, the platform inflation will always be above outside if outside has no inflation rate, okay? But then as the legacy inflation, outside inflation goes up, the legacy will lower its fees because now it's in a disadvantage, okay? So the inflation is going up, it cannot charge as aggressively the fees, the legacy market. So it will lower its fees. So which means that platform can now increase its inflation because outside inflation is increasing, so it can actually compete better, but it cannot increase it one-to-one because the legacy is lowering its fees, okay? So that's kind of the idea. You basically, as the outside inflation goes up, platform inflation increases, but at a rate that's less than 1, which means that eventually it's going to be lower than the outside inflation, okay? So that's kind of a strategic dampening result. So then we look at the planner's problem. And in the planner's problem, we just say that suppose the planner cares only about trade surplus in terms of like matching the buyers and sellers in the most effective, efficient way, okay? So with identical technologies, this means that actually the planner doesn't care where buyers and sellers go as long as they go in the correct proportion. And what is the correct proportion? Correct proportion is the proportion that in the economy of sellers to buyers, okay? You don't want like too many sellers or too many buyers to go because this matching technology is concave, okay? So what that means is, as long as they go to the two markets in this exact ratio, anything is optimal with the same technology. Now, in the decentralized equilibrium, remember the seller-buy ratio was lower in the platform, which means actually the decentralized equilibrium is not efficient, okay? And the use of platform money is actually distortionary. So if you banned platform money, they would be symmetric, and people will go exactly, at this rate to the two markets, and that would be efficient. So with identical technology, optimal to ban private money, okay? But if the technologies are not identical, if the platform has better technology, which is, I think, the more relevant case, given today, this platform has so much like machine learning and data, they can do better matching relative to legacy markets, then it turns out actually having private money can be socially better. And the idea is the following. Now, when the platform has the superior technology, actually the planner would want everyone to go to the platform, okay? In the equilibrium, of course, not everybody goes to the platform, but there are two kinds of efficiencies. One is, this correct ratio of buyers to sellers will not be satisfied in equilibrium. But the second thing is that not everybody is going, okay? So now if you thought of like allowing private money actually allows the platform to attract more people at the cost of distorting the ratio of sellers to buyers, okay? And under some conditions, actually, having more people going to the platform, even if it distorts, especially if the platform has much superior technology, is better, okay? So in that case, you would like the platform have a tool to attract more buyers and sellers, and that's money. So you would like to allow them to use private money in that case. Now let me talk about this extension that we have, which is, in the real world, so far in the baseline model, there is no reason for the platform to accept outside money. I told you that, it's strictly dominated. Now, in the real world, we see a lot of platforms do accept outside money. For example, you go to Amazon, you can use your credit card on the spot, okay? But not on WeChat, okay? So why is like WeChat closed, Amazon open? Okay, this is one thing we want to understand. So here is the extension of the model. Suppose you have some fraction phi, so phi for flexible, of buyers who don't care what type of money they use, okay? And you have 1 minus phi who like outside money. So if they use platform money, they face some cost, kappa, okay? So think of it like these are people who have like their own payment system, their credit card, and their credit card gives them a kickback or something, and they like that, okay? If you tell them you have to use my money, they, face some utility loss, okay? Now, we're gonna say, okay, platform can either adopt a closed policy, accept only its own money, or open policy, which is accept both. And the trade-off is, if you do closed policy, you're gonna lose some of these biased people, okay? But if you do open, you're gonna lose seniorage, okay? So this is the thing, okay? Which one should you go for, okay? So here are some results. These are the proposition numbers from the paper. So, okay, so it's never optimal to accept only outside money, okay? This seems trivial, but takes a bit of effort to prove. But then if the bias is small, so if there are these people who don't like outside money, but the bias is very, very small, then it turns out you want to still close, because you're going to lose some of these people, but very small fraction, you don't care, okay? Now, if the bias is large, on the other hand, imagine, in fact, that these guys totally refuse to use outside money, platform money, okay? Kappa is infinite means they'll never use your money. If you insist on using your money, they're not going to come to you, okay? So then what happens? Actually, the result is kind of interesting here. If there are two thresholds, if the platform, if you have very few flexible people, okay, you want to adopt the open policy, which is, this is intuitive, okay? So this just says that, if most of the people are going to refuse your money, you want to open your platform, okay? Now, the other is not so obvious. So it says that if you have a lot of flexible people above a certain threshold, in fact, you want the closed policy, even though these people refuse to hold your money. And there, the reason is some sort of strategic segmentation. What you do is you say to the legacy, look, take these people, they refuse to take my money, these are yours, okay? And now you're a monopolist over them. So that encourages the legacy to actually raise its fee, okay? Which allows you to raise your fee on the flexible people that you capture. Not the fee, but the inflation, okay? And make more money. So here, basically, it turns out, if there are enough flexible people, closing your doors to these biased people can be optimal, okay? So I actually realized I skipped one other slide, and before I do how many minutes do I have? Maybe. Okay, so I will go back and okay. I think I skipped this one, so let me just, because I'm going to talk about it in the conclusion. It will come out of nowhere. So let me back up and show you this slide. So this was supposed to be part of the motivation, but I think the paper also gives a new perspective on this classic debate between Friedman and Hayek, and there are some very prominent follow-up papers on this, which are basically Friedman said let's let private issuers compete over money, okay? Actually, sorry, it's the opposite. Friedman said if you allow private issuers to compete over money, they're gonna print too much money, and they're gonna destroy value. So you cannot. So he was, I think, thinking about probably this, the banking money era of bank runs and so forth. So he said that this will never work. Having so in fact there should be monopoly over money. And Hayek said no, competition will force issues to maintain value. And the literature, I think, mainly it was kind of more supporting Friedman, which said that because because if you allow private money, because there's coordination, a lot of people have to use the same kind of money for money to be useful, and then whoever is issuing that money will have an incentive to print a lot of money. Okay, so that was kind of the idea. So there will be no discipline in money. So the platform angle says, money is a complement to matching. Okay, so in this world, you don't want to issue too much money, because if you do that, you're going to destroy matching surplus. So carrying money will be costly. So this creates some discipline and kind of says that private money can work. So now let me go to the conclusion in my last minute. Okay, so when platforms have the ability to issue money, they subsidize buyer entry and kickstart cross-network externalities. Resulting equilibrium is not socially efficient, but banning platform money can be worse than allowing for private money, especially if platform has superior matching. There is, rejecting outside money can be a strategy to soften competition when you have people who strictly prefer outside money. And there are these broader implications, which is the slide that I just showed you. The need to maintain matching surplus can prevent overissuance of private money. So the last thing I want to say is that typically money is issued by banks in the current economy. So this paper also raises this question, perhaps we should also allow payment systems to be controlled by platforms. For example, COVID-19 transfers were made to digital wallets in China, which seems like it was more effective than the checks that were sent to people's bank accounts in the US. So that's it. Thank you very much.